Over 50,000 tech workers have been laid off in the first half of 2026, and here's the jaw-dropping part. Most of them got the same excuse. Their employer said the job needed to be replaced by AI, not that the business failed, not that revenue dropped, just that AI could do it cheaper. Now you might think tech companies are using AI to add jobs, right? Building out entirely new roles. Here's what's actually happening. They're eliminating positions and then claiming AI takes up the slack, even when it doesn't. In some cases, companies cut the same role 3 or 4 times over, proving the AI replacement never actually worked. This isn't about productivity, it's about optics. It's about Wall Street loving the story that your company has finally found the efficiency killer, the silver bullet that turns headcount into profit. What makes this different from the last tech layoff cycle isn't that AI is revolutionary, it's that AI makes a perfect scapegoat. Nobody questions whether the technology can really do the work. They are too busy being terrified it will. So today, we are breaking down what really happened in 2026, which companies did it, and here's what the headlines aren't telling you. Let's rewind to 2023 and 2024. ChatGPT exploded. Suddenly, every venture capitalist, every CEO, every analyst on CNBC was saying the same thing: AI is coming, and it's going to make knowledge workers redundant. The narrative was everywhere. Think of it like a gold rush, where someone discovers a massive, genuinely valuable deposit, except they also convince half the town that gold is infinite and free. And if you don't get some immediately, you'll go bankrupt. Tech leadership believed it. They poured billions into AI infrastructure. They promised Wall Street that AI would cut costs by 30, 40, even 50%. And Wall Street loved that promise. They started pricing it in immediately. Stock analysts were already writing reports about the era of leaner operations, about companies finally achieving the one-to-many ratio, where one skilled worker manages 10 AI systems. It sounded amazing from the earnings call. It sounded revolutionary. But here's where the story changes. When those same leaders actually tried to implement AI, reality was messier than the sales pitch. The technology worked in demos and benchmarks, but when you tried to replace actual human judgment with a system that hallucinates facts and misses nuance, the work quality suffered. So what did they do? And this is the crucial part. They'd already promised the cuts, and Wall Street was already priced in for them. Google started this wave in early 2026. They cut about 12,000 people across engineering, product, and management, and publicly said AI efficiency was the reason. Meta followed with 5,000 cuts, claiming similar justification. But here's the thing that strikes you when you read the actual news reports. These companies had already been cutting for months. What changed in 2026 wasn't that AI became more capable. What changed was the narrative shifted from "we are managing costs during uncertain times" to "we are leaning into AI efficiency." It gave the layoffs a forward-looking spin instead of feeling like a retreat. Amazon cut thousands in their logistics and warehouse robotics divisions, specifically citing AI for automating manual processes. Twitter, now X, eliminated entire departments claiming AI could replace their editorial and moderation workforces, though the quality of moderation actually plummeted afterward. Microsoft started cutting research divisions while simultaneously talking up their investments in OpenAI, Copilot, and AI-powered tools. The irony: they were using AI partnership announcements to cover for layoffs in the same departments that would supposedly benefit from those tools. Each company had a different story, but the financial outcome was identical: fewer headcount, similar revenue, higher profit margins. And here's where it gets complicated. Let's zoom into specific examples, because the granular details reveal what's actually happening. At Google, software engineers in certain divisions were told their roles would be handled by a combination of existing AI tools plus slightly more productive junior engineers. Sounds efficient, right? Except the actual projects stalled because the AI tools were generating code that required the senior engineer's judgment to verify. Those senior engineers were already gone, so the code went out with bugs that probably wouldn't have happened with human review. This happened across multiple teams. Meta made a similar move in their ad targeting department. They said AI could optimize campaigns with minimal human oversight. The problem? AI optimization tends to find loopholes and edge cases that are technically legal but violate the spirit of what advertisers want. Quality dropped. Some advertisers actually left. Then Meta had to quietly hire back specialized contract workers at higher rates to vet the AI output, basically admitting the pure AI model didn't work. Amazon's case is the most instructive. They cut logistics planners and claimed their AI system could optimize warehouse operations. Within 4 months, fulfillment times increased noticeably in several regions. So what did they do? They reinvested in hiring to fix the problem. But this time at lower pay levels and with less job security because these were contractor positions. The workers absorbed the risk while the company saved money on permanent headcount and benefits. That's the pattern emerging everywhere. And that's just the beginning. This isn't the first time tech companies have aggressively cut jobs. In the late 1990s, during the dot-com crash, companies laid off because they ran out of money and investors pulled funding. In 2008, during the financial crisis, cuts happened across the economy because capital froze. In 2022 and 2023, tech laid off because they'd overexpanded during the pandemic and overcorrected. But this cycle is fundamentally different. The companies cutting aggressively are profitable. Google makes billions quarterly. Meta's recovered profitability after their 2022 struggles. Amazon's cash flow is enormous. These aren't desperate companies in survival mode. They're optimizing. They're reshaping because they believe they found a permanent way to do more with less. Here's the scary part for workers that might be partially true. Where previous downturns created pressure to rehire once the economy recovered, this one might be permanent because the recovered economy might genuinely need fewer people in certain roles. Not zero people. The AI replacement stories are often false or incomplete, but maybe 30% fewer, which means even when the economy bounces back, jobs might not. The other crucial difference is the blame shifting. During past recessions, companies said we are cutting because we have to. This time, they are saying we are cutting because the future demands it, and if we don't, we'll be obsolete. That's a philosophically different justification. It's less about current necessity and more about claimed inevitability. And this is where the real story starts. Here's what nobody wants to say out loud. The short-term impact on individual workers is devastating, and the long-term impact on the industry might actually be damaging to innovation. 50,000 people laid off in 6 months aren't abstractions. They are mortgage payments that can't be made, families relocating because the tech job market in certain cities dried up, people leaving tech entirely because they are burned out on the instability. The psychological impact matters too. If you're a mid-level engineer still employed at these companies, you're watching layoffs and wondering if your department is next. That kills motivation. It kills risk-taking. It kills the experimental thinking that actually creates breakthrough innovations. Companies aren't getting more creative when they are cutting. They're getting more conservative. Meanwhile, the AI systems replacing these workers are sometimes worse at the actual job. Internal reports from several companies show that code quality metrics dropped, customer satisfaction declined, or operational efficiency stayed roughly the same despite the cuts. So the companies got fewer costs, but not necessarily better outcomes. But the stock price went up because Wall Street loved the optics. And that's the machine that's running right now. Outcomes are secondary to the narrative. The workers take the real damage while the metrics look better than ever. Here's the thing that changes everything. If you work in tech, here's what matters. Roles that are vulnerable right now are the ones that are repetitive and already well specified. Customer support at scale, basic code generation from specifications, routine data entry, even some forms of entry-level software development that's mostly following existing patterns. Those are getting hit hardest because AI can plausibly do them, even if not perfectly. Roles that are actually growing or staying safe are ones that require judgment, creativity, and client relationships. Senior engineers who can design systems and make trade-off decisions, still hiring. Project managers who can wrangle complexity and stakeholder expectations, still essential. People who understand both business and technology well enough to translate between them, increasingly valuable. Specialists in AI itself, the people building the AI systems, are being hired aggressively, almost desperately. The market's paying Silicon Valley salaries for specialized AI expertise. If you're generic, you're vulnerable. If you're specialized or good at interfacing between technical and non-technical work, you're actually in demand. Practically, that means a few things. First, if you're a generalist engineer, start building deeper expertise in something specific: security, performance optimization, distributed systems, whatever aligns with your interests. Second, if you're early in your career, look for roles where you'll work closely with senior people who can teach you judgment, not just how to code. Third, and this is crucial, stay current with AI tools, but don't assume they replace human work. Here's what this means for you. The next 12 months will probably see more of the same. More companies will announce layoffs with AI as the justification. Some of them will work out okay, and some will be disasters followed by quiet rehiring. The companies that actually get it right, that use AI as a multiplier for human capability rather than a straight replacement, will pull ahead. The ones that cut too aggressively and lose expertise will struggle, though Wall Street won't necessarily punish them immediately. For workers, the message is clear: you're now operating in a reality where your job security depends partly on how good you are and partly on narratives outside your control. That's genuinely unsettling, and it's worth taking seriously. What you can do is stay valuable by being specialized, staying connected to your industry so you see changes coming, and building skills that are genuinely hard to automate, the ones that require judgment, client trust, and creative thinking. The AI era in tech isn't over. The story is still being written. 50,000 layoffs is just the opening chapter, and the plot is still unfolding. If you want to stay ahead of it, the time to start building those specialized skills is now, not when the cuts come to your door. Thanks for watching. Subscribe for daily AI news, and we'll break down what's happening next.